Welcome to the Retirement Made Easy podcast, a show created to be your go-to source for straightforward retirement advice. Best of all, it is presented in a language that you can understand. Are you ready for some straight talk on retirement planning without all the fluff? Well, you found the right podcast. Here's your host, certified financial planner, Greg Gonzalez.
Hey, welcome to another episode of the Retirement Made Easy podcast. I'm Greg Gonzalez. Thanks for joining me today. This is episode number 183, which I never really thought or imagined we would get this far. But now, hey, we're at 183. I guess we'll go to at least 200 because you got to hit the 200. That's a big milestone to shoot for. So we'll keep going. You can keep sending your questions in to retirementmadeeasypodcast.com. This episode, I wanted to talk about and speak on this market volatility that's driven a lot by all the talk of the tariffs. And I'll give my perspective on that, of course, but also the lesson here that some of our listeners can take away with. So I hope to give you some perspective on this market volatility we're experiencing and how it's going to impact you and your retirement, of course, but also give you, hey, an update on how it's impacting a lot of our listeners, a lot of our clients, and how they think about their retirement. Because in my opinion, I think this little downturn in the market really bumped people off course. So we're going to talk about that on today's episode. Then we're also going to go through some listener questions and just from questions that people we meet with throughout the week have had that are very, very good questions. I was actually part of a presentation this past week on Social Security planning. It was kind of eye-opening. Wow, Social Security is very complex, and it seems to me, or at least that was my takeaway, being a part of that presentation, was not very many people understand it. So some of the questions later on this episode, we're going to hopefully give you some clarity, maybe things you already knew about Social Security, and it'll just confirm your understanding. But there were a variety of questions that I thought, man, I want to talk about that on our next podcast episode. So that's what we'll do. Aside from that, if you're a new listener, like I said, this is episode number 183. A lot of times I find myself repeating myself on questions and topics, and that's totally okay. I don't expect listeners to have listened to all 182 previous episodes and digested or memorized all the different topics and talking points and questions. Feel free to ask away. Ask your questions. I meet with so many people and speak with them on a weekly basis, and I hear things all the time like, man, I wish I would have known to ask this years ago. And very frequently, after I have a conversation with somebody, I think to myself, man, I wish I would have met this person 5 years ago because we really could have done some planning, we could have fixed some things, and they'd be in a lot better situation today if we had met 5 years ago. So it's never too early to plan for retirement. If you have questions, don't put it off. I would encourage you to ask away. What's the worst thing that can happen? You may not get a response. If you ask a question to our podcast, you're going to get a response. You may not like the answer, or you may not agree with it. That's something bad that could happen. Or you could get an answer that like, wow, that's going to change my life. And of course, we hope the outcome is the latter. But if you have a question, again, visit our website, retirementmadeeasypodcast.com. You can submit your question there. There's resources that are available for free. And I've mentioned this before with our company, Retire Strong Financial Advisors, based out of St. Louis, Missouri. Our goal this year for 2025 is to help 100 people get a retirement plan in place, one that's personalized to them, tailored to their situation, and really the plan will give them a lot of confidence as they look ahead at retirement. There's a form on our website, and you can fill out that form, and then we'll get a hold of you and talk about the process of getting that plan designed for you as you prepare for your own successful retirement. All right, so this week's episode, I wanted to talk about the tariffs that were announced, how that's impacting the market. And the market has been incredibly volatile these last few weeks. I'm recording this podcast in the first part of March. And what you're finding is the US stock market indices are virtually all down, besides the Dow Jones is barely up. The S&P 500's down almost 2. NASDAQ is down almost 6. Small company index is down the most, almost 7% year to date. But the last month, all of these indexes are down. Now, what's very interesting is if you look at the European stock market, it's actually up year to date. In fact, it's up quite a bit. It has significantly outperformed the US stock market. And that's what all the economists are trying to figure out. Portfolio managers in New York and elsewhere, they're trying to figure out is these tariffs, how are they going to impact us short term as far as rising costs for goods that are imported? Are US companies going to have to change their projections for earnings for the second quarter, for the third quarter, for the fourth quarter due to these tariffs? And that's what all these companies are trying to determine at this point is, hey, how much are we going to have to raise the prices for the goods and services that we have? And therefore, our projections for Q2, Q3, Q4, as we look ahead, is that going to bring down our estimated earnings and trajectory of the company? Many companies are already looking at changing suppliers to save costs. And the other big point that I think is worth mentioning is whenever you have laws that go into a place in a very near term, within 30, 60 days, it doesn't give the market time to adjust appropriately to those laws that are going into effect. And so oftentimes the market can overreact to news that it doesn't have time to absorb and appropriately price in. And therefore, that causes a lot of volatility in the market, the big ups and downs and ups and downs. We've had a lot of podcast listeners and prospective clients that are reaching out saying, hey, I'm starting to experience this downfall. I'm seeing my 401k and maybe other retirement savings go down and down. It's starting to make me nervous. Should I be doing anything differently? They're reaching out for help because they're concerned. And there's a couple points that I wanted to make here. If you're interested in 2018, the fourth quarter of 2018, there were the tariffs on China and they were announced then and the market really tanked. And you can look at the S&P 500, the last quarter of 2018, and you can see what I'm talking about. I remember, like I said, like it was yesterday. Mark Twain once said, history doesn't repeat itself, but it often rhymes. And I think that's what we're experiencing again with this whole tariff talk. Again, you can look at the end of 2018. You can clearly see what happened with the talk of tariffs on China during that time period and how that impacted the market. And we're experiencing something very similar today. The other point that I want to make is the last several years for the stock market in general, it's been a very good ride. And a lot of people, in my opinion, and I've met with a lot, I've talked to a lot of people over the last several years, and what I've found is they were more aggressively positioned than they had realized. So what that means is they're taking more risk in their 401k or their retirement savings than they realized. And the reason for that is when the market's going up and up, if you're taking more risk, you're going to get, generally speaking, higher return. And people don't mind the upside volatility when the market's very volatile, but the trend is up and they're making money and their balance is growing and they're thinking, gosh, it's going up really quick. There's a lot of volatility, but it's trending upwards. So this is great. So they don't mind that. Their stomach, their appetite for risk is okay with that as long as it's making them money. But on the flip side, when you run into a period of a lot of volatility and it's trending downwards, meaning they're losing money, they get a little upset. It makes them very nervous. And I've said this before, the better way to deal with risk is to make sure the risk score of your portfolio is equal to the amount of risk that you can handle personally, your appetite for risk. What I've seen over the past several years is a lot of times somebody has like middle of the road, moderate risk tolerance, meaning their appetite for risk is kind of in the middle. And the way they're positioned in their 401k or other investments is more like a 90 or 100, but they're okay with it because, well, I'm making a lot of money and it just seems to go up and up and up. And I can handle the up. I can handle the volatility as long as it's going up. And with this tariff talk and the market decline, you're really seeing the tide turn. And now people are starting to say, wait a minute here. Why am I losing so much money over such a short amount of time? And it's because the risk of their investments was much greater than their appetite for taking that risk. So I would encourage the listeners out there, and especially anybody that's retired or transitioned into retirement and their goals are different now. Maybe they're getting an income off of their investments. So they're more like dividend and income based goals rather than growing the money and saving for retirement during their working years. Again, two separate goals. If that has happened, we need to say, hey, maybe we should adjust the risk of our portfolio. Maybe it's time to make that adjustment given the changes in our life. Maybe we're a couple of years closer to retirement, and maybe now you're more of a moderate risk investor because you don't want this whole thing to blow up and go wrong. And that brings me to another point. For anybody out there that is owning individual stocks, for example, this has been a couple of years ago. I met a gentleman that 85% of his retirement savings were in a single stock. And this stock did very well. I agreed with him. But he said, I can't sell the stock to diversify because I don't want to pay the taxes. And I just looked out of curiosity the other day. In the last few months, this guy's stock is down 40%. Now, he didn't take my advice a couple of years ago to diversify, or at least the last I heard from him, he didn't. But what this means is if you experience a 40% decline in your retirement savings, you're probably going to have to push off your retirement. And then you run into well, if I don't diversify, how long is it going to take for the stock to come back to where it was previously? So I ask you, if you're a year away from retirement, maybe 2 years away, if the market did crash, let's say 30% is an example, how would that impact your retirement savings, your 401k? And would that cause you to work another year, 2, 3 years because maybe you were taking too much risk? That's something that you'll have to answer, think about, talk to your financial planner about, hey, you're so close to retirement. How would this impact you? And are you okay with that if it did happen? So I hope this conversation has been helpful for you with hopefully give you a little clarity on the tariff situation, what happened several years ago in 2018. That was not a quick recovery. You can go and look back, do your own homework. And the other thing is that I want to point out is a lot of times people, they don't want to make changes when things are going good. For example, let's say the market is hitting all-time highs and they say, no, I'm not going to rebalance my investments, my 401k. I'm not going to do it. I don't want to make any changes because things are going so well now. They wait to make changes until the market's in the toilet. And a lot of times that's not a good decision. A lot of times what stimulates people to act or make changes is based on emotion, just like purchasing decisions. If you make decisions based on emotions, whether it's a car purchase or something else, a lot of times you end up regretting those decisions. It's like they tell you, hey, if you're ever very hungry, don't go grocery shopping because you'll just load the shopping cart up with things that look good at that time. By the time you get home, you're like, oh gosh, why did I buy this? All right, we're going to shift gears here. Like I said in the first part of this episode, I was part of a Social Security presentation this last week. And when we got to the Q&A section, there were financial advisors on the call. There were pre-retirees on the call. And just the lack of knowledge when it comes to how Social Security works was kind of surprising to me. But they call that the curse of knowledge. Like I have a very good understanding of Social Security, so it's hard for me to imagine somebody that doesn't have a very good understanding of it and then trying to explain things in a language that they can understand. Again, it takes patience and takes time to teach people. And they call that with anything in life, whether it's a teacher, whether it's a doctor explaining a medical condition to you, it's the curse of knowledge. Whenever you know something so well, it's hard to imagine someone that doesn't understand it. So I want to be as helpful as possible. And if you have questions about Social Security, send them in. I'm not going to call you out and say, oh, I can't believe this person doesn't know this. I'd rather say, hey, gosh, if that's on your mind, chances are there's somebody else that has the same exact question. And I didn't know everything about Social Security years and years ago. It took me years of studying and try to understand it to really become proficient at the ins and outs of Social Security and how to effectively manage Social Security income and make the right decisions. And the way Social Security works now is much different than it was 10 years ago as far as claiming strategies and so forth. And I can only imagine there's going to be some more changes coming down the pipeline. And then we'll just have to pivot and adjust to those. So here were some questions from this presentation that I was a part of, some of the questions that came in. And then I also had some people that went to our website, retirementmadeeasypodcast.com. They submitted their questions over the past few months, and so I grabbed those as well. So as far as claiming your benefit for Social Security, when you go to claim and you say, hey, I want to start my benefit in April, that means the first check will be sent to you in May. So Social Security is a month behind in that aspect. So you've got to understand that. The other thing, they don't mail checks anymore. They only do direct deposit. The day of the month you receive your check, you don't get to pick. You don't get to say, hey, my pension comes in on the 1st. I want my Social Security check to come in on the 15th. They don't give you that option. It's based on when you were born, your birthday. The other thing everybody knows on this podcast, I am big on tax planning, especially in retirement, but you can withhold federal income taxes from your Social Security check. The form is called the FW4V. Now, this is voluntary withholding. So you fill out the form, you select, there's only a couple choices as far as how much taxes that you would like to have withheld. And then you can either mail that in, you could drop it off at the local Social Security office, whichever you prefer. But withholding taxes from your Social Security check is totally voluntary. And what a good retirement planner will do, in my eyes, one of the things they'll do is to map out what your taxes are going to look like in retirement to make sure you're either withholding enough from your Social Security and pension, or maybe 401k withdrawals that you're taking to make sure you're not going to owe a bunch, and taking advantage of tax opportunities like Roth conversions and keeping you in an appropriate tax bracket in retirement. The next question that came in was in regards to the survivor benefit versus the spousal benefit. This always leads a lot of confusion. The survivor benefit, if your spouse were to pass away, as long as you're 60 years of age or older, you would get a survivor benefit. Even though you could have claimed your own benefit at 62, you can actually start that check, which is called the survivor benefit, at age 60. What if your spouse passes away and you're only 55? Hopefully they had life insurance in place or other financial means, so you'd be okay, because your survivor benefit doesn't actually kick in until age 60. And it is reduced if you start at age 60. You don't have to. You can wait until your full retirement age, and you would, of course, get more for your survivor benefit. Now, the spousal benefit, that is maxed out at 50% of your spouse's, or in some instances, ex-spouse's, full retirement age benefit. So what that means is, let's say your spouse, their full retirement age is 67. Their benefit at that time is $3,000 per month. If you wait until you are 67 to claim your spousal benefit, you will get 50% of your spouse's benefit, which is $1,500. So 50% of $3,000 is $1,500 per month. Now, if you wait past your full retirement age, it doesn't go up. You don't get any more. But the key here is, let's say you're both 67 and your birthdays are identical. Your spouse would have had to claim their benefit at $3,000 a month for you to get your spousal benefit, which is half of that. So if you're both the same age, you're both 67, and your spouse wants to wait until 70 to claim his or her benefit, you can't get your spousal benefit yet until they claim at 70. So the way that would work is, let's say you're 67, your spouse is 67, they're holding off on claiming their higher benefit until 70, and you're saying, gosh, my benefit's only $800 a month. If I claim it today, my spousal benefit is going to be $1,500 a month. So you would claim yours today, get the $800 a month, and then in a couple years, when your spouse flipped on their benefit at 70, you would see an increase in yours. They would bump it up to $1,500 per month. The other thing about the spousal benefit is you can collect earlier than your full retirement age. It's just you're not going to get half. They're going to give you a reduced percentage of that. there is a reduction factor. And that surprises a lot of people. The other thing I wanted to point out is if you start your benefit at 62 and you're getting $2,000 per month, I want to remind you that, hey, when you turn 65, and if you hop on Medicare at age 65, assuming maybe your spouse is not working, you're covered under their group health insurance. Let's just say at 65, you sign up for Medicare, great. Your Social Security check that you were receiving, that $2,000 a month, is going to be reduced because you got to pay the Part B premium, which in 2025, it starts at $185 a month. It's income based on your income, modified adjusted gross income in 2023, 2 years ago. And this seems to surprise people. I've mentioned this on earlier podcasts where somebody's getting $2,000 a month. All of a sudden now they're on Medicare and they see their Social Security check go down from $2,000 a month to $1,815. And they say, gosh, where did that $185 a month go? Well, Medicare isn't free. That was your Medicare Part B premium. So the next question that we had was working while collecting your Social Security check. A lot of people, they've kind of heard people say, well, I can only work and make X amount of dollars because I'm getting a Social Security check. And if I make any more, they're going to start reducing my Social Security check. So for 2025, let's say you're 62, flip on your Social Security benefit, you can make $23,400 for the year, and it will not impact your Social Security check. For every $2 you make above $23,400, they deduct $1 from your Social Security check. Now, there's a special rule in the year in which you reach your full retirement age. And for anybody born 1960 or later, it's age 67. So the rule says this: in the year in which you reach full retirement age, your earnings limit is higher. It's $62,160. And for every $3 above that limit, they're going to then deduct $1 from your Social Security check. So in the home stretch, in those months leading up to you obtaining full retirement age, that limit does almost triple. So for people wanting to work part-time or in some capacity in retirement, many times that can help determine when the best time to start your Social Security benefit is based on how much you're earning. And then the last point on this, somebody asked during this presentation, if they're withholding money from my Social Security check because I had a part-time job, do I get that money back? Well, you do. You start getting it back gradually at your full retirement age, but they do not pay it out in a lump sum upon reaching your full retirement age. Like I said, they start paying it back gradually to you. And then the last question that I had, somebody emailed me, and then we had a follow-up conversation based on what they called their retirement plan, which was an Excel spreadsheet, and it showed the amount of money in their 401k, and they were taking a fixed amount out of that 401k for 20 years. After a certain amount of time, of course, it ran out. I think it was between 20 and 25 years, the money was gone. And my critique of this plan is a couple things. One, I want to refer back to episode number 6. This is called The Retirement Story Everybody Needs to Hear. We will throw a link to it in the show notes that you can listen to. It's a nice story that you can really buy into, and you can really understand in a very simple story how to plan for a successful retirement and one of the biggest risks out there. And it goes into the science behind it. But just looking at a 30-year retirement, and I think over the past several years, people have really opened their eyes to, hey, inflation is a real thing. When inflation is 0 or 1%, we really don't notice it. But when you've got inflation that's 4, 5, 6, 7% or higher, like we've experienced, it starts to really open your eyes and say, gosh, how are people making it that are on a fixed income? And if we look at a couple, a 62-year-old non-smoking couple, they're projected to have a life expectancy of 30 years. And this is just an average couple. That's 92. And so if you look at a box of Cheerios, I eat Cheerios almost every morning. I like just the regular yellow box Cheerios. Let's say it's $4 a box today. It's probably higher. But at 3% annual inflation, That means in 30 years, your $4 box of Cheerios is going to cost almost $10. It's $9.71. Now, I think a box of Cheerios is probably going to go up every year more than 3%. So what we really need to realize here is our cost of living. Every year, everything we buy will cost more, whether it's an oil change, whether it's your grocery bill, your utility bill, your car insurance, your cell phone bill, eating out. Our trash and recycling company at my house, it went up 30% in 1 year. And people in our neighborhood were absolutely livid. So to think that your costs are going to stay the same and that you can withdraw a fixed amount, let's call it $30,000 a year, out of your retirement nest egg, your 401k, whatever your nest egg looks like, to say, okay, the first year I take out $30,000. The next year I take out $30,000. The following year, year 3 of retirement, I take out that same $30,000. That's assuming that your bills don't go up, your household expenses don't go up. And I just don't see how that's possible unless you're cutting back, like you're getting rid of services maybe. And the next point I wanted to make was you want to make sure that your retirement plan allows for your money to last longer than you do and needs to account for any long-term healthcare expenses you have. Generally, that's in the last 5% of your life. So with that being said, I think if the average American retires at 62 and we're planning on a 30-year retirement with a goal of our money running out in the 20 or 21st year, and then I guess you got to live on Social Security or any pension that you might have to take you the rest of life expectancy, I really, really question the wisdom in that. Because to say, okay, well, if I live past 82, I run out of money, and then I guess I'll figure it out from there, I don't think that's a smart plan. And I say that with as much compassion as I possibly can, because my own grandmother, my own late grandmother, went through that and depleted her life savings and was trying to make it on a small Social Security check and a small pension. And she was just squeezed so bad. And the last several years of her life were very hard on her emotionally, psychologically. She lost a lot of her dignity, and she didn't want to be a burden on her family by asking for help. And so we didn't find out about it until after the fact. So from my late grandmother's experience, not having a pleasant retirement, what one would consider a successful retirement, I think that's why I have this burning desire and passion to help people so they don't have to go through what my grandmother went through. So my message here is have somebody double check your plan. Even if you're fairly confident that, hey, this retirement's going to work out the way I think it is, and I think I have my ducks in a row, I just encourage you to get a second opinion on your strategy. Because even if somebody points out one or two things that you didn't think of or you hadn't considered, it'll be well worth it. I hope this episode of the Retirement Made Easy podcast has been helpful. Visit our website, retirementmadeeasypodcast.com. I'll see you next week. And remember, always dream big.
Content in this material is for general information only and not intended to provide specific advice or recommendations for any individual. The content in this material does not necessarily reflect the views of LPL Financial. This is a hypothetical example and is not representative of any specific situation. Your results will vary. The hypothetical rates of return used do not reflect the deduction of fees and charges inherent to investing. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments might be appropriate for you, please consult your attorney, tax advisor, or financial planner prior to investing. This is a hypothetical example and is not representative of any specific investment. Your results may vary. All performance referenced is historical and is no guarantee of future results. All indices mentioned are unmanaged and may not be invested into directly. There is no guarantee that a diversified portfolio will enhance your overall returns or outperform a non-diversified portfolio. Diversification does not protect completely against market risk. All investing involves risk, including loss of principal. No strategy assures success or protects against loss. Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. The SmartVestor program is a directory of financial professionals. Neither Dave Ramsey or SmartVestor are affiliates of LPL Financial or Retire Strong Financial Advisors. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution, RMD, in the year you convert, you must do so before converting to a Roth IRA. This information is not intended to be a substitute for specific individualized tax advice. We suggest that you discuss your specific tax issues with a qualified tax advisor. Fixed and variable annuities are suitable for long-term investing, such as retirement investing. Gains from tax-deferred investments are taxed as ordinary income upon withdrawal. Guarantees are based on the claims paying ability of the issuing company. Withdrawals made prior to age 59 and a half are subject to a 10% IRS penalty tax, and surrender charges may apply. Variable annuities are subject to market risk and may lose value. Riders are additional guarantee options that are available to an annuity or life insurance contract holder. While some riders are part of an existing contract, many others may carry additional fees, charges, and restrictions, and the policyholder should review their contract before purchasing. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution, RMD, in the year you convert, you must do so before converting to a Roth IRA. This information is not intended to be a substitute for specific individualized tax advice. We suggest that you discuss your specific tax issues with a qualified tax advisor. Retire Strong Financial Advisors and LPL Financial are not endorsed by or affiliated with the United States Social Security Administration or any government agency. Retire Strong Financial Advisors and LPL Financial are not endorsed by or affiliated with the U.S. Centers for Medicare and Medicaid Services or any government agency.
Thank you for listening to the show today. Check us out at our website, retirementmadeeasypodcast.com. And if you want some help from Greg, submit your questions at the bottom of the page or sign up for a 30-minute retirement coaching session with Greg. We'll see you next week.